I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He's also an analyst for Bearing Asset Management. Welcome to the show, John.
Hey, Jim. Good to talk to you.
A new trend, or not so much a new trend? U.S. corporations have been buying back their own stock like crazy over the past couple of years. Has that trend changed at all?
Well, a stat came out this week that implies that maybe it is going to change, because basically corporations have been buying back huge amounts of stock and paying higher and higher dividends in lieu of building new factories and generally spending on their plant and equipment. And the number that just came out is that corporations have been returning 108% of their earnings to shareholders via stock buybacks and dividend increases. And that means that they're spending everything they have and then some on stuff that doesn't improve their productivity or increase their ability to compete in the global marketplace or really anything else, and that they're borrowing to cover the difference. So corporate leverage, that is the amount of debt that they have relative to the size of the company, is at record levels as well. And so what the guys in charge of America's companies right now are doing is paying themselves big bonuses via higher share prices and increased earnings per share and higher dividends, and leaving their successors over-leveraged, much less healthy and productive companies. And now finally, the markets are starting to react to this, because the shares of companies with the biggest buyback programs are underperforming for the first time in several years. Up until now, it's been a good strategy from the point of view of your share price to buy back stock. It has pushed up your price, other things being equal. Now that's not the case anymore. So we've reached the point where corporations have record amounts of leverage, and buying back more stock doesn't seem to be improving their share price, because the markets presumably are focusing on the leverage now and not on the short-term pop that comes from share buybacks. So very possibly this is the end of this cycle of massive increasing share repurchases. And if you take that away from the U.S. market, the implication is that prices won't go up as much from here. You know, that's one of the big props of the market. It's been hundreds of billions of dollars a year flowing into U.S. equities. And if that's going to stop or even reverse, which it normally does at the bottoms of cycles, you know, companies start issuing equity at much lower prices than they bought it back 3 or 4 years before. And so if we're heading into a cycle like that, where the supply of new stock is going to go up rather than down, then that's going to put a lot of pressure on stock prices in the U.S. So that's one negative indicator, one bearish indicator pointing towards lower stock prices in the near future.
Is the U.S. dollar going to keep climbing at the rate it has been, or is there a stall point somewhere?
Well, that's another issue that ties into corporate earnings, because the dollar has been extremely strong, the U.S. dollar. And that makes it harder for U.S. companies to sell things abroad, and it's generally been blamed for most major corporations' underperformance in the last quarter. You know, you read the quarterly report, and it's, oh yeah, this was great, and this was great, and this was great, but the strong dollar made our earnings go down. And so to the extent that we raise interest rates in the U.S. while the rest of the world is cutting interest rates, which is what the Fed here is promising to do in December, that would make the dollar a little stronger, other things being equal, than it is now, which would make the headwind blowing in the face of corporations a little bit stronger than it is now, and presumably it would make corporate earnings grow a little more slowly or actually fall from here. And again, that's a problem for the stock market, because ultimately a stock price is determined by the underlying earnings of the company that's issuing the stock. You know, when you buy a stock in a company, you're buying a share of its future income. And if its future income is going up, that's good for the price of your stock, and it's bad if the future earnings are going down. And so to the extent that our policy here in the U.S. makes earnings go down, then that should bleed back into the stock market and make equity prices weaker than they otherwise would be. So a lot of different things point to a bear market from here for U.S. earnings, or U.S. Stock prices. And the one thing that's leaning against that is global capital flows. The rest of the world is such a mess. You know, Europe and big parts of Asia and, of course, big parts of Latin America are all in various kinds of turmoil. And the rich people in those countries are looking for places to put their money because they don't want to leave it at home where they don't trust the new government or the military adventurism that's going on in their region or whatever. You know, in the Middle East, there's crisis everywhere you look. So if you're a rich Saudi, you want to get your money out of the country. China, they got a credit crisis that is not very transparent. You can't tell what's happening, but you know something bad is happening. So if you're a Chinese millionaire, of course you look for Vancouver real estate or New York real estate or London real estate. Well, an awful lot of money is apparently flowing into the U.S. from the rest of the world. And to the extent that that money comes in here looking for safety rather than near-term returns, some of it might flow into stocks, which would push stocks up otherwise. So you can't say with certainty that the U.S. is heading into a bear market. You know, so there are pluses and minuses right now, but on the corporate earnings front, it's very, very negative. And it wouldn't be a surprise if another round of bad earnings reports had a huge impact on stock prices towards the end of the year.
Well, the biggest company in Germany, Volkswagen, of course, hit by that emissions scandal. Well, they've lost money for the first time in 15 years. What does that say about Europe?
Well, the emissions scandal is, it's kind of a one-off. Hopefully it's a company-specific thing, and the rest of the big car makers aren't doing the same thing, but it's definitely a big thing for Volkswagen. That's one of the biggest equities in the world. You know, that stock is in all the major mutual funds, and because of that, it affects a lot of people beyond just Volkswagen executives and Volkswagen workers, and the people who get tax revenues. You know, Germany presumably gets a ton of tax revenue from Volkswagen. To the extent that they're losing money, then Germany suffers from this too. So, yeah, there's no way to know how big a scandal this is and how far-reaching it is, but right now it's potentially pretty serious. They just announced this morning that it wasn't just diesel engines that they were cheating with. You know, that some of their gas-powered cars are also not performing the way they promised that they would. And so this recall that's ongoing now might go on longer, involve more cars, and cost billions more dollars than anyone had expected. And it's open-ended. We don't know how many cars it's going to be at this point. So, yeah, it's a huge amount of money, and it's a huge reputational hit for Volkswagen. They're going to sell fewer cars in the future because people don't trust them. And that's a very big deal for a car company. Well,
I was going to say, too, and it's not just Volkswagen. Apparently, Audi and Porsche as well can be affected by this.
Yeah. If it turns out to be a lot of different automakers playing similar games, then this is a really big deal because the global auto industry is third or fourth, I think, in the world for employment, and it's just really big. You know, it's just behind oil, and maybe one other industry, maybe telecommunications. I'm not sure, but you know, it's huge, and it's everywhere.
Well,
and
if it has hit everywhere, is this not an incentive to buy an electric car where you know at least it's not going to be cranking out more pollution than they say it is?
Yeah. You know, the electric car technology is almost here. It's really close. Batteries probably need one more generation, one more iteration to be flat out, straight up competitive with internal combustion. And that day is coming. So, of course, that doesn't mean that there won't be some problem with, pollution related to batteries or something like that in the future. We can never know. But, yeah, to the extent that internal combustion engines are turning out not to be as clean as we were promised and to be much more expensive when they are made clean, then that's a net plus for the electric car industry and for the battery technology research and all the other aspects of clean tech that apply to transportation. So yeah, the timing is pretty good from the point of view of somebody like Tesla, which is just now ramping up mass market electric cars.
Well, we just saw a news story on TV. One advantage of buying one of those expensive Teslas, if it gets stolen, there's an app on your phone where you can tell exactly where it is to within 10 feet. And of course, they nailed the crook the second he stepped out of the car. And they said, if you're going to be a crook, remember, you steal a Tesla, you're not getting away.
Well, I don't know if you've been in one of those, Jim, but they are computers on wheels. And they have internet connectivity, and they basically tell you everything that's going on with the car. So yeah, it really is kind of a 20th century versus 21st century thing. When you drive an electric car, it really does feel like the future. It feels like the next generation of auto technology. And so, yeah, I think there's a very bright future for electric cars.
I can tell you one thing that's going to happen with electric cars, though. You're going to have a higher pedestrian accident rate because they're silent. And I noticed when I was driving an electric car, people were stepping out into the street right in front of me because they listen for cars, but they don't look. And they're going to have to put a little noisemaker or a clicker or something on the car or an artificial engine noise because they're so silent, people don't know you're coming.
That'll definitely be an issue, but it's a totally surmountable problem. We can figure out something that stops pedestrians from walking out in front of electric cars. But yeah, the silence is a beautiful feature right now. It's so nice.
It's weird when you stop at a traffic light and you can hear everything around you except your car. You don't realize how much noise. Even we have very quiet engines now, but you don't know the noise your car makes until you don't have it.
And you're not even sure the car's still on. You stop and it goes completely silent.
Actually,
your first reaction is, did I stall out?
Right, the car I drove had a little ding that it told you're ready to go. It goes ding, and a red light or a green light comes on the dash because, people are used to, how do I know the car's still working? And I asked too, what about heat in the wintertime? That's a big issue in Canada. They said, no, it's great. You have electrically heated windshield wipers, electrically heated seat, steering wheel. You're warm and toasty and ready to go. That's a nice thing too. So it doesn't stall when it's cold. It's, as long as the batteries, I guess, don't freeze. That could be a problem.
That's one issue with the technology. But, all of this stuff is fixable with more efficient batteries.
And John, the automotive business, if you look at history, we started off with electric cars. So we're just improving old technology, that's all.
Yeah, it's really come full circle. You're right. The original cars were electric. And then gasoline turned out to be this amazing energy storage technology because you can really pack a huge amount of energy into a gallon of gas. Well, it's enough to move 3,000 pounds of metal 30 miles. That is a huge amount of energy. So, it took a really long time for battery technology to then leapfrog internal combustion engine technology. And it's finally happening, and that's very cool. I think 20 years from now, electric cars will dominate. But the process of transitioning from one technology to another isn't an overnight thing. It takes a really long time for an old industry to be displaced, especially when it's huge and extensive, like the automobile industry. And then we've got the issues of the raw materials that are necessary to build batteries on a global scale. We don't know if there's enough lithium out there, right, to make a battery to replace every internal combustion engine. And so that's what we'll have to find out going forward. We're going to need cheap supplies of the materials, and we're going to need to ramp up factories, and it'll take a long time. But in the meantime, we will have some pretty good early model electric cars to choose from. And, the next car we buy, we will seriously look at an all-electric model.
Plus, the challenge now that driverless cars apparently are going to be with us in about 5 years. It's going to change the way people commute. You'll have your car drop you off at work, and then it's going to scoot off someplace else. And a lot of urban futurists are saying, well, we won't need giant parkades and parking lots near where you work. But one problem that will happen is everybody's going to be dropped off at the same place at once. And the next traffic jam will be at 5 o'clock where everybody gets off work at once and they want their car to pick them up. So you're going to have to invent ways.
That's a separate problem, though, because you can have mass transit solutions at the same time that you have electric cars driving people to work. And so that's a city planning issue, not a technological issue. It's completely solvable with the right sets of traffic laws and mass transit options and pedestrian-friendly road, stuff like that. You can do it.
And also, too,
an interesting challenge.
Yeah, and with the robo cars, they can drive like right next to each other on the freeway at highway speed because they're all electronically communicating with each other. So you don't have to leave that space for you, the human driver, to react and stop if there's an accident. All the cars will be communicating together. Of course, the first time one of them gets hacked, you could drive an entire freeway into the ditch.
Yeah, the self-driving cars have a lot of issues before they're ubiquitous, because my computer crashes every once in a while.
Yes.
My cell phone acts up, and that's fine. It doesn't kill anybody when it happens. But let the computer running a car screw up in the same way. The blue screen of death is going to take on a whole new meaning when it's a car, right, instead of your computer screen. So we've got a long way to go in terms of redundancy and safety before everybody's just being driven around by their cars. But, that'll happen. You let 3 new generations, for instance, of computer chips evolve, and then we're 1,000 times faster and vastly more stable than we are now. And, maybe it's doable on a mass scale without undue loss of life. So, yeah. That's probably coming. And you're a lot more efficient if you're being driven, because then you can work for the hour that it takes to get to work.
Or read a book, which for a lot of people is something they haven't done for years, because they claim they don't have the time to do it.
Yep. And that's an extra hour or two a day, depending on your commute.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with John Rubino. John, the president of China has hinted very strongly that they're going to have 6.5% growth, and that'll be officially announced when their 5-year plan comes out in March. Can he, with any confidence, predict 6.5% growth every year for the next 5 years?
Well, top-down driven economies can generate growth in the short run. We saw it with the Soviet Union, who actually had a nice run early on before they crashed and burned, and then Japan in the 1970s and 80s, where the Ministry of International Trade and Investment directed capital to various large-scale factories and things like that, and they grew for a long time before they hit a wall. And now China is the latest iteration of that kind of governmental mindset. And so they have been able to borrow huge amounts of money and direct it to big projects for the last 20 years. And so they've grown in terms of reported GDP. But a lot of what they built, because it's been politically motivated rather than generated by market forces, has turned out not to have been needed. They've got a lot of airports and roads and bridges and entire cities that nobody's really using. And so those things aren't generating the cash flow to pay off the related debt. So they've reached the point where they probably can't, just choose a GDP number and then direct a bunch of borrowed money towards hitting that GDP number with any kind of accuracy and efficiency anymore. And should they try to do it that way, they'll just end up building up even more debt and having an even bigger credit crisis out there somewhere in the future. So if they're going to rely on market forces to generate their growth, or to determine their growth, then they can't predict it. They can't say what it's going to be 3 or 4 or 5 years from now. So their 5-year plan is sort of a wish list, just like it is for every other capitalist country. And so what they say should be taken with a grain of salt. Already people kind of understand that China's numbers are just kind of made up. They report a GDP number just a day or two after the quarter ends, and it's exactly what they said it was going to be. And there's no way you can measure GDP for a country of 1.3 billion people, many of whom still live in third world conditions where there's not very good communication and no real way to measure what they're doing. You can't know what China's numbers really are.
How big of an impact is their new policy where you can have 2 children instead of just one going to have?
It's a slight increase in growth and a slight increase in resource consumption. So probably not a huge deal, certainly not a huge deal in the short run, and probably not a huge deal in the long run, because as countries get richer, their birth rates naturally drop. And so China's birth rates have been, to the extent that one-child policy worked, they had a birth rate that was similar to what you see in Europe right now and in Japan. And so it's not out of the ordinary, and you wouldn't expect it to jump to some super high level. It's not going to go to Saudi Arabia's level or something like that, where you have lots of kids in each family. And so it probably won't make that much of a difference. China's big issue is that they borrowed a huge amount of money, and now they've got to figure out how to pay off all the loans. And it's not going to be easy because they borrowed money in an amount that exceeds the entire size of the U.S. banking sector in the last 7 or 8 years. And for a country with an economy that's smaller than the U.S., that's a huge amount of debt to deal with. And so that's their big issue. They've got to figure out how to generate the cash flow to cover the debt that they've taken on when a lot of the things they built with that money aren't working out. So China's got some challenges ahead of it, and the idea that they can just announce 6.5% growth from here on out and hit that target is probably unrealistic.
Are higher interest rates in the U.S. better than having negative interest rates? There's a bank in Boston now that charges you to put money into the bank.
Yeah, well, negative interest rates are the next stage of this process. We borrowed huge amounts of money, and that slowed down economic growth, and then all the central banks of the world responded to the slowdown with lower interest rates and even easier money. And now we've hit the point where if we're going to lower interest rates again, because the world is slowing down, we've got a global economic slowdown going on as we speak. And if we respond to it in the traditional way, that means you've got to push interest rates down to negative levels. And we're in uncharted territory there. We've never had countries with widespread negative interest rates, and we've certainly never had regions or the entire global economy with on average negative interest rates. And we're heading for that. So we're trying an experiment, the results of which are inherently unknowable because we've never done this before. We've never attempted anything remotely like this, so there's no way to know what it's going to turn out to be. And I suspect it'll be bad because it's distorting all the pricing signals that capitalism depends on. All capitalism really is prices bouncing around. Everything else flows from that. So if prices are allowed to bounce around in response to legitimate needs and opportunities among the actors in the system, that's good. That's when capitalism is working. But if you short-circuit the pricing mechanism by manipulating the price of money, for instance, which is the most important price in a market, then it's not capitalism anymore. Everybody's flying blind. So all the people who are going to be investing for the future, building factories and buying stock and educating themselves, they have no idea how to do it because they don't know what the world's going to be like in the future because there are no pricing signals that legitimately give them clues about the course of their market and of the global economy. So I think the result of widespread negative interest rates will be catastrophic. massive malinvestment that can't pay itself off, that leads to mass bankruptcies and then bankrupt governments and yada yada, all the way down to the bottom when the whole world is in a 1930s-style depression. So I think that's what would happen, and I think we might just try that experiment to see.
Well, usually the word negative means something bad, and in this case it probably will.
Yeah, well, it means a good thing if you're borrowing money, because then they pay you to take their money. But you have no idea what to do with that money. So you're going to screw up. And that's the bad part of it, So yeah, it's a mess that we're creating, and we're just going to have to live through it because it looks like the institutional momentum out there is heading this way, and there's nothing anybody can do to stop it.
John, thanks a lot for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.